Welcome to our High Rock video, our High Rock monthly video for October. I am Scott Tomlinson, and with me on the call today is the portfolio manager, Paul Tepsich, and the founder of High Rock. We're going to start by talking a little bit about September, which was a difficult month for markets. Paul, not a whole lot of positive asset pricing in the month of September, huh?
There was not a lot of asset price appreciation in the month of September, as you can see by this chart here. Pretty much everything was down except for really oil and natural gas, which is very localized in the U.S. Put in a pretty decent month as well, but pretty much every commodity, every bond, whether it be government, corporate, you name it, and pretty much every stock market was down. US dollar skyrocketed, and that's certainly why assets, commodities, US stocks priced in US dollars put in a pretty rough month.
Yeah. And importantly, and we'll get to this in a minute when we talk a little bit more about the tactical portfolio and the high yield mandate, but fossil fuel energy prices continue to rise. So that is something that's actually working in favor of our portfolios.
Yeah, and we get some of that through our balance mandates as well.
But what's not working for our portfolios to a large degree are the rest of the markets, the rest of financial market assets, and specifically September was a difficult month. But we can look at the year to date. Now these are just prices, and I'll talk about that in just a second. But certainly you can see how things have moved, and there's a lot of really the balanced mandates are pretty much just maybe slightly higher on the year. And let's look at this in a longer term perspective as well. Let's look at the 3-year as well, and we can see that it's pretty much the same. Balance mandates have been dragged lower significantly by their weighting in bonds, and that offsets any positives from global equity prices. So now this is just prices, and it's important always to look at assets in terms of their total return. Total return includes interest and dividends that are paid, which as we can look at a few of these asset classes and see, but up in the top left, there's the S&P 500 ETF, earning just 9.75% per year over the last 3 years. So these are annual average returns, by the way. TSX, the next one down, 8.5%, and then global equities up 635, 640. So what we're focused on for the most part is that what is going on with balance, because most of our mandates are balanced. And so we can look and see what's happened over the course of the last 3 years in balance mandates. And while they were up in 2020, they were down a lot in 2022. So there's not been a great deal of strong performance for a balance mandate. And of course, if you look at the bonds on a total return basis have been down over the last 3 years. So Paul, what stands out to a large degree for our clients is that we do have some alternative asset classes in the higher yield mandates, and again focusing on that to a degree, and what's in the tactical model. So clients with exposure to those situations and the fossil fuel energy that we've had in our portfolios. I'll let you talk to that, but certainly has been a mitigating factor and helped performance overall. And I'm going to talk a little bit more about bonds and portfolio performance in a bit, but I'll let Paul talk a little bit about our special mandates, the high yield mandate, tactical model and what's coming up.
Sure, thanks, Scott. Maybe even just go back to that screen with the 3-year performance. I'm not going to give you a number, but our high yield mandate has a 3-year, and it's not always been fully invested, to be honest, has a 3-year compound annual growth rate or return of higher than the S&P 500 or the ZCN, which is the Canadian Composite Index. So you're taking structurally senior risk. You're not taking equity risk. You're taking senior unsecured, in some cases, senior secured credit risk. And that performance is higher than the equity risk. So, and again, I'm not going to say what it is. If anybody wants to know what it is, they can contact us directly. But we're very happy and proud of that performance. Knock on wood, we didn't just jinx it. A lot of that outperformance has come through, as Scott mentioned, fossil fuel energy risk. We've had a pretty strong weight. We had a good call in that, but it is a diversified portfolio for sure. One thing I would mention here, I mean, obviously what sticks out on this screen is the bond universe or the bond market, the XBB in the bottom right. You know, at some point, hopefully we see some mean reversion. This is going to be the 3rd year in a row of negative returns for the US Treasury market and the Canadian bond market. Unheard of. Historically, never has that occurred in the past. This is the absolute worst stretch. I believe it's 38 months of drawdowns in the government bond market. So what's happened is quite simply a matter of economics 101, supply and demand. So as the money supply grew so dramatically with massive monetary and fiscal stimulus because of COVID 3 years ago, we now have the opposite occurring. So as the money supply increased, the demand for money decreased, and that's why we had rates, 10-year US Treasuries down at 50 basis points. The opposite is occurring now with the money supply growing negatively. So we're around minus 4% growth in M2, which is a pseudo measure of money supply. So as the money supply decreases, the demand for money increases. And that's why we're seeing rates where they are today, which is substantially higher, you know, 10-year Treasuries up, you know, bordering on 5%, but around, what are they right now as we speak? They're at 477, and that's down. They were at 485 yesterday at one point. So we're going to need to see the money supply stop growing negatively before we see rates stabilize and do better. So we can move on. Scott, the next thing I would talk about in the special mandates, we are hosting a call next Tuesday at 5:30. Most everybody should have an invitation. If you did not get one and you would like one, hop on. Notify us. It's going to be on Canadian preferred shares. There's been a fair bit of dislocation in the last couple of months. We have run a special preferred share mandate back in 2017 through 2020 that worked out quite well. We have a robust valuation model that I don't think anybody else has, and this is one of the benefits of High Rock versus going to some advisor at a big bank or even an independent. You're not going to find this sort of analysis anywhere. It should be an interesting call, and we think it's an interesting time. It's not appropriate for everybody. There's a lot of concentration in the portfolio. There's a lot of risk associated with it, but it could also provide a very interesting outright opportunity, and it could provide a hedge. So it has to be suitable for your investment portfolio. If you'd like to know more, please contact us.
Yeah, that's great, Paul. And of course, as everybody knows, and as I remind everybody monthly, we're always focused on your long-term goals and do things like our preferred share mandate suit your long-term goals. that's a question that you can ask us directly. And certainly for some, yes, but for some, maybe perhaps not. So we want to make sure that we've got the right strategy to get you to your goals, and that strategy evolves with different markets as we're experiencing now, and also evolves as time progresses and as you get closer to utilizing money in your portfolio, or if you're retired and utilizing your portfolio for your costs of living, then strategy is a very important thing as well, and we need to discuss that. So again, always want to have these conversations with our clients, and we are always available. So if you're listening to this and it's time to have that conversation, or whether you just want to touch base, please get in touch. We all know where we are. You all know where we are. Okay, let's quickly talk about global equity strategy. As I mentioned last month, we were using what I consider to be overvalued equity prices to take some profits especially for clients that rebalance regularly for cash flow needs. So we've been doing that. Now we're seeing equity prices coming down. We're getting to a point where we're starting to look for value. We have to weigh that with a number of other factors as well. As Paul mentioned, and as we've seen so far, bond prices are at multi-year lows. So there's some interesting opportunities in the bond world as well. So again, it's all about your respective allocation strategies, but global equity strategy at the moment, we're neutral, still wanting to have some cash if prices and equities come down as the economy slows. Paul, I'll let you talk about the tactical strategy. Paul, you're on mute.
Yeah, I was on mute. My apologies. There's construction noise in the background. We did talk about our position in AutoCanada ACQ stock. We're not married to it. We traded that pretty well, and we are out of it. And it's since sold off from our sell point. Happy to be out of it, to be honest. Extremely volatile and illiquid. We did add a US dollar energy bond, Baytex, which we own the stock in. The stock certainly has bounced off the lows from the high $3 range to got over $6. Now it's selling off a little bit with oil having popped up towards 95 and now back down to 88. The reason we bought that Baytex bond was really just to add some yield. We consider it equity risk, even though it is a bond. They are, I don't think they're as volatile as they should be, but we are on the side of caution when we measure risk. So that was yielding about 8.35 when we bought it. So we'll hold on to that as a core holding. It just adds a little bit of energy exposure in a less volatile way, being a bond, not stock. We continue to have some good carrier or interest income from NuVista, which is natural gas producer. That bond has sat there at par 101 for forever, yielding us roughly 7.5+%. Pretty happy with that one over the last number of years. One thing I would note is that dividend stocks that we own in the tactical model, all of them, to be honest, from BCE, Enbridge, TRAP, right through to one of my faves, Yellow Media, any dividend stock, as interest rates, when I say interest rates, I mean government bond yields rise, dividend stocks tend to get hit. Because you can earn more going back to a government bond than you can in a dividend-paying stock. So it's a competitive process for yield, if you will, whether it's interest income yield or dividend yield. So those have all been been hurt, as has the overall equity market, because there are a lot of dividend-paying stocks in there. That's something I would note. And you can see if we went way back in the slides, the REITs are largely dividend payers through distribution, and they've been hammered. So, and we do not own any REITs for not just that reason, but for other cash flow distribution reasons. So that's that for tactical. Fixed income, there's really nothing on that table chart or pie chart rather, that helped us much over the month of September, to be honest. We all know government bond yields rose dramatically over the month, which means prices fell dramatically. Investment grade bonds, a little bit less so, and high yield bonds, quite a bit less so. And preferred shares, actually, some of them did okay. But overall, that certainly, as we've seen in the previous charts, was not all that helpful. I think that's about it, Scott.
Okay, and I'm just going to add, when we're talking about fixed income strategy, again, and I've mentioned this before, but just to remind our clients that with bond prices down significantly, we need to remember that the current market valuations for bonds are not the same as their maturing valuations, and portfolio performance is actually taken from the current value of your portfolio, as if it were all to be sold on any particular day. However, we know that in some cases, 40, 50, or 60% of your portfolio is in bonds. And for the most part, we actually intend to mature those bonds at their par value, which is their original issue amount. This means with interest rates higher and bond prices down, as Paul was saying, the bonds are currently being valued at approximately a 10% discount to their maturing value on aggregate. So with a portfolio of 40% bonds, for example, that is a 4% discount to your portfolios. That in time, that value will be made up as the bonds approach maturity. So when you look at your current performance, and you'll be getting your quarter end summaries later this month, you need to think about and add in the discounted value for more what we call a realistic understanding of the real value of your portfolio. And as always, I'm happy to go through this with you individually. I've had a number of conversations with clients around this, and really enjoy having these conversations, because it's important to understand that the impact of the bonds on your portfolio isn't as significant as it may look, and we'd like to point this out and certainly assist you in understanding this.
Hey, Scott, that's a great point. And I'm just going to add, this morning when I was looking at our portfolios, just to give you an example, and coming from the last 25 years as a high yield and distressed trader and portfolio manager, there's a couple definitions of what's classified as a distressed bond. Some could be 1,000 basis points in spread over government bonds, but the other one is to look at it as on a price basis. So let's look at on a price basis. You were mentioning some of these bonds that we own are priced at 90 cents on the dollar versus 100, which is par. It's a 10% discount. That 10%, when the bond matures at par at 100, that would be classified as capital gains. That's so you get a better after-tax income, if you will. But I'll tell you, we have a lot of bonds that are priced a lot lower than 90 because of where interest rates are. These are lower coupon bonds, and I'll give you one major example, and it's a long time to maturity because it's about 30 years, but US 30-year treasury bonds that we own are priced at 46 cents on the dollar. 46 cents on the dollar. Like, if that was a corporate bond at 46 cents on the dollar, you'd consider it bankrupt. It would have to restructure, etc. This is going to mature at par. Now it's 30 years away. But if we look at more of those bonds in the 4, 5, 7-year area that are trading at 80, 85 cents on the dollar that are good, solid credits. Boy, that's very good after-tax income. I think that is a pretty stout what's called pull to par. That bond every day, if it's priced at 80 cents on the dollar, every day it's going to pull to par over the next 5 years until it actually matures at par. So it goes up every day, even though it's been a rough period for the last 3 years. It's now is actually a good time, I think, to continue to add some of those shorter term 5-year area corporate bonds.
And Paul, I'll just add to that. This is what we talk about. You know, these dislocations mean that some clients should be reviewing their asset allocation strategies, because as they get closer to maturity, it may be more important to have less risk or be depending on less risk that comes with owning equity assets, and have more secure risk with owning these very, very nicely discounted bonds.
Yeah, great point. Great point. And it's you know, hopefully our clients are, and we're doing that with them, is always reviewing, but I think it's a great opportunity to look at some of these opportunities, some of these credits in the 5-year bucket.
Yeah. All right, we've taken up lots of your time, and as always, we want to thank you for taking the time out of your busy schedules to tune in. We'll be back with our next update at the beginning of November. So until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Diane, we want to wish you all a very happy Thanksgiving. And of course, if you need to get in touch for any reason, please don't hesitate to do so. Until next month, then, take care.